Hi guys, so welcome back to the video, and today I'll be talking about ratio analysis. Now ratio analysis is a very important part of the syllabus because this is something that we'll be using later also to analyze companies and performances, and if you later on go into the stock market or invest or something like this, you'll come across ratio analysis on a regular basis. So it's a very important thing. Now, primarily before you start ratio analysis, some important things that you need to be very aware about is the components of a balance sheet and profit and loss account. So what are the components of a balance sheet and profit and loss account should be very clear to you. Otherwise, when you see the ratio, and in the ratio it will be like shareholders fund divided by uh, something. So you need to know what shareholders fund means and stuff. So as I go along and explain the ratios, I'll try and explain all these terms as well, so that it's easier for you to um, calculate the ratio. Okay. Now ratio analysis is not something that is only done in financial accounts. Okay, ratio analysis is also used. For example, I took the example of cricket in the last video, so I'll take the example of cricket again. So for example, if there are two batsmen, okay, one batsman has scored 70 runs, another batsman has scored 30 runs. Now which batsman batted better? If you try to compare them only on the basis of runs, that's not a fair comparison. So in cricket we use a strike rate. So what is a strike rate? Strike rate is a ratio basically of the runs divided by the number of balls. So for example, the person who scored 70 runs, he takes maybe uh, let's say 60 balls to score 70 runs. Whereas another person, he scores 30 runs in 10 balls. So his strike rate is 300, and this person's strike rate is almost just above 100 something. So now you can see, now if you see the strike rate, you can compare both the batsmen. Again, we have another ratio in cricket, like average. So like what is the average of that person? Or even for bowlers, there are ratios like this. So I'll not go too much into those details, but you can understand like how ratio is used to kind of see the consistency of the company's returns and compare them to the industry. Okay, so in ratio analysis, we have four basic types of ratios. The first one is liquidity, then liquidity, leverage, activity, and profitability. Now, in the previous video, I was explaining that there are different stakeholders for every company, and each stakeholder uh, requires something from the company. Now, for example, liquidity. Who will require liquidity? Liquidity, firstly, liquidity and leverage is very similar. Liquidity talks about the short-term ability to repay something. So, for example, I have taken a short-term credit from my supplier, and I've given a credit to my customer. So those short-term credits or that you take or give, those are called liquidity. Leverage, on the other hand, is a long-term thing. So like leverage, it comes when you take a long-term borrowings or a debt instrument or something that will increase your leverage. So that is two, liquidity and leverage. Now, who will look at my liquidity? Liquidity will, my bank will look at my liquidity, my creditors will look at my liquidity. Leverage, who can look at my leverage? So equity shareholders will look at it. Other borrowers may look at it. Activity ratio and profitability. So I'll discuss those when we get started. Okay, so I'll directly take up the, yeah, let's take up the ICI study material first, and we'll explain it from there. So I hope everything is visible, and let's get started. Show video panel. Okay. So now I have the ICI study material open. You can see it's a 70-page document, and I don't think it's worth your time to go through the 70-page because you're not required, or you don't need to be an expert in ratio analysis. You just need to do it for the quiz. You can obviously go through it if you want, but anyways. So I would suggest when you start, if you after this lecture, you can watch this, you can refer to this document, and there are like more details also. Excuse me. Yeah. So as I was talking liquidity, we have mainly three kinds of ratios in liquidity, and each ratio, and as you move towards more liquidity, so let me get started first. Current ratio is the first liquidity ratio. So this is what this ratio says. One sec. Yeah. So as I was saying, liquidity ratio, the first one is current ratio. Current ratio, the ratio is current asset divided by current liability. Now, generally, this ratio ideally should be 2:1, but over time, with more concepts uh, like lean systems and just-in-time inventory and stuff, it started to reduce, and now it's considered that 1:1 is a more ideal current ratio. Now, current asset. What does my current asset have? So, main components of current assets are my cash and cash equivalents, trade receivables, inventories, and other prepaid expenses and stuff like that. Current liabilities, so any kind of even short-term advances, so like any advances which are less than 12 months, those will come under current asset. Current liability contains my short-term loans, my trade payables, any dues that I have, like uh, let's say wages payable or something like that. So that will come in my current liabilities. Now current asset divided by current liabilities gives me current ratio. So what is the meaning of this ratio? So it says that, I'll just zoom in. It says that a simple measure that estimates whether the business can pay short-term debt. So it gives me the ability to see whether my business can sustain my short-term debt, whether my current liabilities are being paid out of current assets. So you can see if your current assets are more, then the ratio will be more than 1. If your current liabilities are more, it will be less than 1. So ideally, it should be more than 1, so that your current assets are sufficient enough to pay your current liabilities. You don't have to like take like borrowing. So like other capital, you don't need to, your current assets are sufficient enough to maintain your current liabilities. Okay. Quick ratio. Now, as we move down towards quick ratio and cash ratio, it will become more and more liquid. So what liquidity means is that, let's say you have ice, and like liquidity means that if that, let's say you have a fixed deposit of 5 years in the bank account, that fixed deposit is not liquid because that fixed deposit can only be taken out of the bank after 5 years. Okay. Or you have some kind of a policy that has a recurring deposit and something. So these are very non-liquid funds. You have money, but it's locked in for 5 years. But your cash, your bank account, or something, these are all liquid, highly liquid assets. Now, what are quick assets? Quick assets are basically current assets minus prepaid expenses. So if I go to the next tab over here, you will see, one sec. Let me scroll up a little. Yeah. So current ratio, I'll zoom out. Quick ratio, current assets minus inventories minus prepaid expenses. So these are those current assets which are non-liquid. Like we are moving towards more and more liquid assets. So cash and cash equivalent is liquid, trade receivables is liquid. So uh, inventories is not liquid because you can't really sell off inventories whenever you want. Okay. Prepaid expenses are like you have already paid for them. How will you like uh, it's like you prepaid and then you just have to receive that service or something. So these are non-liquid. So I'm removing inventories and prepaid expenses. So if you uh, remove this, whatever is left is your quick assets. That divided by current liabilities, it gives you the current ratio. I mean quick ratio or acid test ratio. These are alternative name. Okay. So generally, this quick assets consist of cash and near cash assets. Okay. Next ratio is your cash ratio. So again, you can understand like you're going even more liquid, and you're just taking your cash and bank balance and marketable securities. Marketable securities are those short-term, highly liquid investments that are less than 3 months. So that divided by current liabilities gives you cash ratios. You can ignore basic difference interval, it's not really that common. And finally, here it says that net working capital ratio. So net working capital is basically your current assets minus current liabilities. That gives you working capital. So net working capital is a measure of cash flows than a ratio. So it just says that how much money is coming from your current assets and how much money is going out. If current assets is more than current liabilities, then it's positive for me, and I'm ideally I want something that is more. Okay. Um, Again, with every ratio, if you remember whatever sir has taught in class, that every ratio, every industry has a specific current assets and current ratio. So ideally I should aim to be close to that ratio. So this is my liquidity run. Okay, I'll add the link to this thing in the description, so you can refer to this later on. Okay. Now capital structure ratio. Capital structure ratio gives you the ratio between the various components of the capital side. So like equity and liability side. Again, this can also be done through a like vertical analysis as well. But then again, so shareholders equity divided by net assets. So net assets means basically net assets. What is the composition of your, how much of your assets is contributed by equity? Okay. So it indicates owner's fund in the company to total fund invested. Net asset will be equal to liabilities. Okay. So how much of the inventories, how much of the asset is funded by shareholders equity? Okay. Just remember that shareholders equity is on top. Similarly, debt ratio, total debt divided by net assets. It's essentially the same formula, just shareholders equity and debt. Again, one important thing that I mentioned in the last video as well, that shareholders equity includes your equity share capital as well as your reserves and surplus. Okay, that is important. Don't forget to include reserves and surplus, because that money belongs to the shareholder. Okay, debt to equity ratio, again it's shareholders equity in the bottom. So debt to equity, to debt means the total debt divided by equity. So it indicates basically the composition of how much percentage of like composition of debt and equity. So if your debt is more than equity, that means you have a very high leverage. Okay, and if your debt is less than equity, that means you have a low leverage. So if you're trying to borrow more money, people will be willing to give you money. Whereas if you have a very high leverage already, then people will not give you money as much, because they know that uh, you have a very high interest burden already and you might not be able to pay. Okay. Again, with the debt equity ratio, a investor, he will ideally want very less debt, because the debt is a fixed financial burden. Okay. So investor will always want, investor and debt securities both will want a very low debt equity ratio. Debt to total assets, these are not really that important, so you can read them, but it's not really important. Okay, next we come to coverage ratio. So coverage ratio is basically indicates the ability of the company to finance its fixed expenses. So for example, debt service coverage ratio, this what this does is indicates how much, like, does the company have enough funds to cover its fixed like here, what is your debt service coverage? So debt includes interest and EMI part. Okay, so in interest and installments, is my earning enough to cover my interest and installments? So that is what I have to. So earnings available for debt service. So if you see the, let me take you over here. This is basically the format of the profit and loss account. So revenue from operations, other income, total income. Total income, say you reduce the cost of goods sold, gives you gross profit. Then you take out general selling administrative expenses, finance cost, and depreciation. That will give you EBIT, and then interest, a profit loss account, and profit before tax, and tax and profit after tax. Ideally, I should remove the finance cost from here because I have taken it for interest. Okay. Now, out of this, when you come back to here, earnings available for debt service. When is which is my earning that is available for debt service? So this one, this earning before interest and tax is what is available for me to pay off my debt. So this is what I'll take in the numerator and then divided by the uh, like interest and installment. Similarly, interest coverage ratio for interest coverage ratio, I need to explain one thing. Here, interest coverage ratio is given as EBIT by interest. So EBIT by interest. Whereas in case of what sir has done in class, let me see if I can open this. Okay. So here in class, what has sir has done is that here interest coverage is given as PAT plus interest by divided by interest. So the difference is what sir has done is that PAT, so PAT is this one, profit after tax plus interest. So this one plus this one divided by interest. That is what sir has done in class. However, in ICI's module, it is written as EBIT. Now, the difference here is that if you take PAT plus interest, you are reducing taxes even though, so you're taking care of the taxes, whereas if you take EBIT, you're not taking care of the taxes. So ideally, you should take PAT plus interest only. Okay. So that might be a confusion if you're referring to both. So I would suggest go with what sir has taught in class, PAT plus interest divided by interest. This is more appropriate. Okay. Um, so it measures the ability of the business to meet its interest obligations. Here it gives the commitment to debt service like interest and installments. This only covers the interest portion. Preference dividend, don't need to study this part. Fixed charges not required. Okay. Activity ratio. Activity ratio, it tells you that how much of your sales, like so if I take you to activity ratio over here. Here, so these are the activity ratio. It says that these ratios are employed to evaluate the efficiency with which the firm manages to utilize its assets. Okay, these ratio indicate the frequency of sales with respect to its asset. These assets may be capital asset, working capital, or inventory. So you can see whatever is going on here, it talks about the asset. So total asset turnover, fixed asset turnover, capital turnover, current asset, working capital. So let's go back here. So it says that turnover means sales. Whatever your business turnover refers to sales. Now, what this ratio indicates is that sales divided by cost of goods sold divided by total assets. Okay, so for example, let's say that your total assets is 100 rupees and your sales is 1500. So your total asset turnover ratio is 15 times. So what it says that with 100 rupees of asset, you are making 1500 rupees of sales. Okay, ideally it should be more than the assets. So it there are two companies, both have 100 rupees of assets. Okay, now one company is making 800 rupees of sales, one company is making 1500 rupees of sales. So that means that if my asset turnover ratio is more, it says that okay, the second company which is making 1500 rupees of like say 1500 rupees of sales, that is utilizing its assets more efficiently and turning it over more to generate more sales. So that asset is being turned over more to create 1500 rupees of sales, whereas the second company is not able to do that and they are only able to generate sales of 800. Got it? Okay, so asset turnover is done in a similar way. So always in the numerator, you will either have sales or cost of goods sold. You can do either one. It's not really fixed. But here in Sir's example, in all the activity here, he has taken it as sales. So it's better to take as sales. Again, with these ratios, a little bit of adjustment is allowed. So it's not very hard and fast that you would have to do this. Fixed asset turnover ratio, sales, cost of goods sold. So again, sales of goods divided by fixed asset. Earlier we took total assets. This is only fixed asset. Then capital turnover is net assets. So net assets again your basically fixed assets plus current assets minus current liability. So it's net assets. So fixed assets plus working capital, and then only working capital. So by this, what we are you trying to say is, okay, let's say company has sales turnover and it has 10 times of sales turnover total asset, 15 times of sales turnover of fixed asset, and 30 times the sale turnover working capital. That means with a very low working capital, it can create a lot of uh, sales. Okay, that's what this indicates. So measures the efficiency of working capital. This measures the efficiency of the net assets. This measures the efficiency in which 1 rupees of fixed asset is used. So this one fixed asset, it indicates the overcapacity or poor performance of the equipments. Okay. Inventory turnover ratio. Inventory turnover is again, it's a very specific. So working capital includes inventory. So again, you're drilling down into inventory, accounts receivable, daily credit sales, and so on. So I don't think these are too important. Next is profitability ratio. So profitability ratio is the most easy ratio. So profitability ratio can be of 3 types. One is your gross profit. So gross profit is what? Gross profit is here. If I take you to here, gross profit is your total revenue minus cost of goods sold gives you gross profit. Now, if you take the gross profit divided by the revenue from operations, that gives you gross profit margin. If you take the operating income, so gross profit minus selling general minus depreciation gives you EBIT. This divided by revenue from operations will give you operating margin, and then profit after tax divided by revenue from operations gives you net profit margin. Okay, so here, so gross profit divided by sales, net profit divided by sales, operating profit divided by sales. Okay, expense ratio, again expense ratio is again, if I take you here, so cost of goods sold divided by revenue from operation, this gives you the how much percentage of your sales is your cost of goods sold. So if one company has a cost of goods sold of 60%, another company has a cost of goods sold of 25%, that means that 60% of my value of that good is coming out of the uh, cost of that good. Okay, so maybe that could be minimized. So that's how you refer to that cost of goods sold. So COG is divided by sales. Operating expenses is again admin expenses plus selling general overhead divided by sales. Operating ratio, these there can be thousands of ratios. These are like just one or two ratios that are given over here, but just remember the logic of these things. Profitability ratio is again return on this is very something that everyone has very heard of, ROI of your college and everything. So it's how much return you get divided by the number of amount of investment that you've made. Measures the overall return of the business, fund or capital employed or assets. Return on asset is specific to net profit divided by assets. Return on capital employed is the return. So one thing to note in this case is something that changes is that here it's only earnings, here it's net profit after tax, this is EBIT. Now there's a logic behind this. It's not like okay इसमें ये ले लिया उसमें ले लिया, ऐसा नहीं है. Net return on net assets talks about net profit after taxes, because your assets include your interest expenses. So assets is funded by both capital, your shareholders fund and debt fund. So I'll take the net profit that is available after the total assets. Like I mean, I'll take the net profit available after paying both like interest, after paying interest. But when it comes to return on capital employed is your only your equity shareholders. Now, if I don't take this EBIT, then the capital employed will be very skewed. Okay, so pre-tax, post-tax, this is pre-tax. Then if you deduct the tax percentage, it will give you post-tax. And return on equity. Okay, so I said it wrong. Capital employed includes both your equity capital and debt capital. So that's why I've taken, because I'm taking debt capital and equity capital both, I'll take the income that is available for both. So EBIT is before paying the interest. So that's why EBIT I've taken. Whereas if you come here to return on equity, you'll see that this is net profit after tax minus preference dividend that is only the funds that is available for my equity shareholders. Net profit, after you come to the net profit, you pay your preference shareholder, and whatever is left is your distributable income. That is called net profit after tax minus preference dividend divided by equity shareholders fund. This gives you return on equity. Okay, I think this part might not be that clear. I'll not talk about it again because of time. Um, so you can refer to the main details over here. If you go through these things, it's already written over here. If you want more details, like what is ROC, what is ROCE, and stuff that. Okay. Profitability ratios required from point of view of owners. So what is the owner going to see? What is my earning per share? So I have one share. What is, how much am I earning per share? So that is net profit available to equity shareholder. This same thing, net profit available to equity shareholder divided by number of equity shares standing. So if I have 10,000 shares in the company and the company is earning 8 lakh, so what is my earning per share? 8 lakh divided by 10,000. So that gives me 80 rupees. Dividend per share is the amount of dividend paid to equity shareholders. See, net profit after available to equity shareholder, this can either be distributed or not distributed. So this gives me that 80 rupees. Out of the 80 rupees, I have only given 10 rupees dividend. So that is my dividend paid to equity shareholders divided by number of shares outstanding. So this gives me how much the company is giving me as dividend only. Okay. Dividend payout ratio gives you the dividend per equity share divided by earning. So how much is my dividend? So 10 rupees dividend, and my market and the earning per share is 80 rupees. So it's 10 divided by 80. So out of the 80 rupees that is earning, it's only giving me 10 rupees. So that is dividend payout. Uh, Price earning ratio is my market price of the share. So market price of that share could be, let's say, 200 rupees, and the earning per share is 80 rupees. So 200 divided by 80 is my price earning ratio. So why is price earning ratio important? Price earning ratio is my, how much more am I paying? So if I'm earning 80 rupees, but I'm paying 200 rupees for that share, that tells me that I am paying almost 2.5 times my earnings. So that is how costly that share is. Dividend yield not required, earning yield not required. Market value by book value, so market value divided by book value. Book value, let's say it's 10 rupees per share, and market value is 200, so it's 20. Okay. And Q ratio is market value of equity and liabilities divided by replacement, not required, leave it. Okay, so these are the ratios. Now for what is important for your exam purpose, for the quiz purpose. Okay, so one thing that they might ask is, they might give you different things, like they might give you that, okay, operating profit is this much, depreciation is this much, what is the operating profit ratio. Okay. Another thing that they might ask is, like, which of these is a type of shareholder, is a type of ratio. So like liquidity, leverage, activity, or profitability. So you have to tick mark. Okay. Expense ratios, it might also ask, like, they'll give you the ratio and they'll ask you that, okay, which of the following is uh, not a liquidity ratio. Okay. I'll do some questions also. So I think okay guys, so that's it for the video, and I'll take the questions in the next, like in a different thing, or maybe I'll do it live, so that it's easier for everyone to follow the questions, and if you have doubts you can ask. I hope you guys enjoyed it. I think it's a little long video, and koi nahi, it will help you for the end term as well. So and in general, this is something that is very important. So thank you for watching, and please subscribe, and if you have any doubts, leave it in the comments, and let me go and do some pre-reads now. Okay, thank you for watching.